AI Compliance, Banking, EU AI Act. After August 2nd, your AI chatbot is a compliance liability. Here's what banks still get wrong. By Michael Oiknine, CEO. Call VU Inc. published April 24th, 2026. On August 2nd, 2026, the EU AI Act's high-risk provisions become enforceable. In 15 weeks, the definition of AI failure in a regulated industry changes from a customer service problem to a legal one. And most banks are not going to be ready. This is not speculation. Wolters Kluwer surveyed 148 financial institutions in Q1 2026. Only 26.4% said they are confident their AI and machine learning initiatives meet regulatory requirements. Flipped, that is, 73.6% of banks sit somewhere between somewhat confident and we have no idea in any other examination context. That distribution would trigger an industry-wide alarm. In AI, it has not. That silence is about to end. What actually changes on August 2nd, 2026? On August 2nd, 2026, the EU AI Act's high-risk provisions become enforceable, with penalties up to 7% of global annual turnover, or 35 million euros. Banks using AI in credit scoring, creditworthiness, evaluation, insurance pricing, employment decisions, and customer-facing regulated activities fall within scope. For a mid-sized international bank, that is not a line item. That is a board meeting. The EU AI Act is the first comprehensive AI law in the world. Its high-risk provisions cover systems used in credit scoring, creditworthiness evaluation, insurance pricing, employment decisions, and a long list of other regulated activities. If your bank uses AI to triage customer complaints, answer fraud disputes, qualify loan applicants, or route mortgage inquiries, at least some of that activity falls inside the high risk definition. The penalties are not theoretical. Non-compliance with the high-risk provisions can trigger fines of up to 7% of global annual turnover, or 35 million euros, whichever is higher. And the EU AI Act is only the nearest deadline. The Colorado AI Act, SB 24-205, takes effect on June 30th, 2026, 10 weeks from now, with $20,000 per violation for any deployer serving Colorado consumers. The ANAIC Model Bulletin has already been adopted in 24 states. SR 11-7, the Federal Reserve's decades-old guidance on model risk management, is now being applied by examiners to generative AI without waiting for anyone to write a new rule. The old excuse, "We are waiting for clearer regulatory guidance," does not survive August 2nd. From that date forward, waiting is not a strategy. It is a documented risk position that a regulator will eventually ask you to defend. Why does audit liability spike? After the enforcement date, before enforcement dates, an examiner finding an AI compliance gap is a conversation. After enforcement dates, the same finding becomes a matter requiring attention or matter requiring immediate attention, MRI. As attached to individual officers, public consent orders follow. D&O insurance. Premiums rise. Plaintiff firms get templates. The cascade is global, not just EU-specific. The real story is not the fines. The real story is what happens to audit liability after August 2nd. Before enforcement deadlines hit, an examiner finding an AI compliance gap is a conversation. The bank gets flagged, promises remediation, submits a timeline. Friction, but manageable. After enforcement deadlines hit, that same finding becomes a matter requiring attention or a matter requiring immediate attention. which are the two most dangerous letters in banking supervision. MRIAs, in particular, have a way of attaching themselves to individual officers. Public consent orders follow. The OCC, the Federal Reserve, and the CFPB have all named individual compliance and technology officers in recent enforcement actions. And the AI context is going to accelerate that trend, not slow it down. The second order effect is the insurance market. D&O policies are already adding AI-specific exclusions, or raising premiums for banks that cannot document their AI governance. Some carriers are asking to see AI risk committee minutes as part of underwriting. A bank that cannot produce those minutes in Q3 is a bank that pays more for D&O in Q4. The third order effect is the plaintiff's bar. Once a regulator publishes a consent order naming a specific AI-driven harm, plaintiffs' firms have a template. They do not need to prove the facts from scratch. They already have a regulator on record saying the bank did something wrong. We saw this pattern with ECOA and fair lending in the 2010s. We are going to see it with AI disclosure, AI hallucination, and AI bias. Claims starting in late 2026. Banks that treat August 2nd as an EU issue are missing the broader point. The deadline is the trigger. The cascade is global. Why is we have AI policies not an answer for regulators? Policies exist in documents. Compliance failures happen at runtime. The written policy cannot. Prevent a chatbot from skipping a TCPA disclosure, hallucinating a fee schedule, or failing to disclose it is AI. Only runtime enforcement can. Most banking AI deployments are structurally broken because their controls are retrospective, not preventative. Most banks I talk to have AI policies, written policies, board-approved policies, governance frameworks, referenced in the annual report. On paper, everything is fine. The gap is between policy and runtime. Policies exist in documents. Compliance failures happen at runtime. In the moment, a chatbot tells a customer something wrong, fails to disclose that it is AI, hallucinates a fee schedule, or skips a TCPA disclosure because no one wrote that check into the conversation flow. The written policy cannot prevent any of those failures. Only runtime enforcement can. This is where most banking AI deployments are structurally broken. Teams deploy a large language model from a vendor, layer some prompt engineering on top, add a logging mechanism for post hoc review, and call it governance. That setup will fail any serious audit because the controls are retrospective. The regulator does not care what the bank noticed 2 days after an interaction. The regulator cares what the bank prevented at the moment the interaction happened. The 73.6% of banks that are not confident are mostly in this posture. They have the vendor, the prompts, the logs. They do not have enforcement at process completion. They do not have a verifiable trace showing the AI followed every required disclosure, escalation, and policy constraint for every customer interaction. And on August 2nd, a trace of that kind stops being optional. What does runtime compliance enforcement actually look like? Runtime compliance enforcement means compliance rules are enforced at the moment a customer interaction happens, not retrospectively through log review. Every AI interaction runs through a policy layer that enforces required disclosures, blocks out-of-scope answers, forces escalation when needed, and produces a verifiable audit trail mapping to specific regulations. A new category of tools is emerging to solve this specific problem. The category does not yet have a name everyone agrees on. Some call it runtime AI governance. Some call it compliance enforced CX. Call VU's framing is workflow risk management, applied at the moment the workflow executes. The principle behind all of them is the same. Compliance cannot be a document a bank refers to after the fact. It has to be a set of rules the AI system cannot violate at runtime. Every customer interaction runs through a policy layer that enforces required disclosures, blocks out-of-scope answers, forces escalation. When the AI is out of its lane and produces a verifiable audit trail showing what rule was evaluated, against what input. In practice, this means every AI-driven customer interaction generates a per-interaction compliance record, not a log file. A structured record that maps to specific regulations, TCPA, FCRA, ECOA, UDAAP, EUAI Act. Transparency Obligations, NAIC Model Bulletin Sections, Colorado AI Act Consumer Disclosures. Required disclosures happen by construction, not by prompt engineering. The AI cannot respond to a consumer about a credit-related matter without generating a record that the ECOA mandated. Adverse action explanation was available, even if it was not triggered in that particular interaction. Policy changes propagate in minutes, not quarters. When the CFPB issues new guidance on AI, generated communications, the bank changes the policy rule, and every subsequent interaction is governed by the new rule. No vendor ticket, no model retraining, no retraining data freeze. The audit trail is designed for examiners, not for engineers. A CCO can hand an examiner a report that says, in Q2 2026, our AI handled 2.4 million customer interactions. Here are the 147. That flagged for review. Here is the resolution for each. Here is the rule that was applied. That is, an auditable compliance posture. Everything short of that is narrative, and narratives do not survive MRIAs. This is what runtime enforcement means, and this is what the 26.4% who said they are confident almost certainly have in some form. The rest of the industry is trying to get there before an examiner arrives. What is the cost of digital compliance? Neglect for U.S. banks. Cost of digital compliance. Neglect, CoDN, is the dollar exposure from AI and digital CX failures across regulated workflows. A large U.S. bank can face up to $46 billion in CoDN exposure per year. The median mid-sized institution faces $300 million. CoDN is accounting invisible. It does not show up on P&L until the regulator finds the bank, and then it is too late. At CalView, we have spent the last year modeling what we call the cost of digital compliance neglect, or CoDN. It can also be read as the cost of doing nothing when it comes to regulatory exposure. CoDN quantifies the dollar impact of AI and digital CX failures across regulated workflows. Our model incorporates regulatory fines, legal exposure, reputational impact, operational rework cost, and customer lifetime value lost. It covers the full loss surface, not just the obvious line items. $46 billion maximum CoDN exposure per year for a large U.S. bank. $300 million median CoDN exposure per year for a mid-sized institution. Most executives, we show these numbers to assume we must be citing worst-case outliers. We are not. These are steady-state exposure figures against current AI deployment patterns and the regulatory posture we are entering. This cost does not show up on the bank's P&L until the regulator finds the bank. And then it is too late. That is why CoDN is almost never discussed in the executive conversations where it should be. GAAP does not capture it. The CFO's dashboard does not show it. The quarterly earnings call does not mention it. It is economically real but accounting invisible, which makes it the same class of phenomenon as opportunity cost in economics, not captured by the books, but very much there, and a cost that good. Executives are supposed to address before the market forces them to. Opportunity cost is what separates average capital allocation from great capital allocation. CoDN is what separates average risk management from great risk management. You do not see it on the P&L until the day it arrives as a fine, a consent order, a class action settlement, or a D&O premium spike. On that day, it stops being opportunity cost and starts being a line item. Every CFO would prefer the conversation to happen before that day, not after. Two things drive the size of the number. First, banks underestimate the frequency of AI-driven interactions that touch regulated workflows. An AI chatbot answering a simple question about fees is touching UDAAP. An AI triaging fraud disputes is touching Reg E. An AI pre-qualifying a loan applicant is touching ECOA. Every interaction carries regulatory weight, and mid-sized banks are running millions of these interactions every quarter. Second, the exposure per non-compliant interaction is increasing, not decreasing, as the regulatory environment hardens. You can model your own bank's exposure in about 2 minutes. CoDN.callvu.com takes a few inputs about your institution's size, AI deployment footprint, and customer interaction volumes, and returns in exposure estimates specific to your bank. No sales call required to see the number. If the number surprises you, it probably should. That reaction, on its own, is useful data. Do U.S. banks without direct EU operations need to worry about August 2nd? Yes. Most U.S. banks have EU exposure they have not cataloged, including cross-border wires, correspondent banking, expatriate customers, and European subsidiaries of corporate clients. The EU AI Act follows the customer and the data, not the headquarters. U.S. regulators also borrow EU frameworks, and plaintiff firms cite EU enforcement to establish industry on notice in U.S. lawsuits. For a U.S. bank with no direct EU operations, August 2nd feels abstract. It should not. 3 reasons. First, most U.S. banks have some EU exposure they have not cataloged. Cross-border wire, processing, correspondent banking, expatriate customers, European subsidiaries of corporate clients. The EU AI Act follows the customer and the data, not the headquarters. A U.S. regional bank processing a wire for a French client is in scope for the transparency obligations on that interaction. Second, U.S. regulators watch EU enforcement and borrow frameworks. SR 11-7 is going to be reinterpreted in the context of generative AI, and the reinterpretation will look a lot like the EU AI Act's risk classification system. The OCC and CFPB are already signaling this direction in speeches and guidance. U.S. banks that wait for U.S.-specific enforcement will face an examination framework that is already shaped by EU precedent. Third, the insurance and litigation consequences we discussed earlier do not care about. Jurisdiction. A plaintiff's firm in Texas can cite an EU AI Act enforcement action to establish that the industry was on notice. The industry was on notice is the phrase that unlocks treble damages under certain consumer protection statutes. Banks that assume geography protects them are not pricing in how litigation exposure actually propagates. The cost of doing nothing by August 2nd is not one thing. It is a compounding set of exposures that most banks are not tracking as a single portfolio. CoDN is an attempt to make that portfolio visible. What should a bank CCO or CIO do in the next 15 weeks? 4 priorities. 1. Map every customer-facing AI deployment to specific regulations at the interaction level. 2. Identify which interactions have runtime enforcement versus post hoc review. 3. Build the audit trail before regulators ask. 4. Brief the board on current exposure, regulatory timelines, and examination. Readiness gap. If I were advising a bank CCO or CIO today, my list would be short and concrete. 1. Map every customer-facing AI deployment to the specific regulations it touches, not at the system level, at the interaction level. Most banks skip this step because it is tedious. It is also the only step that gives you a real picture. 2. Identify which interactions have runtime compliance enforcement and which have post hoc review only. Prioritize converting the highest volume, highest regulatory weight interactions to runtime enforcement first. A week spent on the top 5 workflows buys more protection than a quarter spent on everything else. 3. Build the audit trail before you need it. When an examiner asks for documentation, the answer, "We can generate that," is not as good as, "Here it is." The former is a promise. The latter is evidence. August 2nd is the date the industry collectively learns the difference. 4. Brief the board. Not a governance slide deck. A specific briefing on the institution's current AI, exposure portfolio, the August 2nd timeline, the NAIC and Colorado timelines, and the gap between. Current state and examination-ready state. If the board is surprised by any of this in Q3, someone has not done their job in Q1. The window to get ahead of August 2nd is still open, but it is closing fast. Banks that move in the next 15 weeks will be differentiated from the 73.6% of the industry that is not confident. Banks that wait will be in a queue with every other bank trying to remediate at the same time, with the same small set of vendors, in the same constrained timeline, under the same examiner attention. See your bank's CoDN exposure in 2 minutes. The number you calculate this afternoon is the number the industry will be talking about in Q3. Get ahead of it. Visit codn.callvu.com. Book 30 minutes with our team. Visit callvu.com. Michael Oiknine is the CEO of CallVU Inc. CallVU builds runtime compliance enforcement for AI-driven customer experience, helping regulated institutions quantify and reduce their cost of digital compliance neglect.